Good evening, everyone. This is Ahmed Youssef from Immigrant Services Calgary. Today, we will have a presentation in partnership with National Bank of Canada. Today, we will have a presentation about the difference between the different saving plans, plans that we have here in Canada. And before we start, we would like to tell you a little bit about Immigrant Services Calgary. Immigrant Services Calgary is an immigrant serving agency that has been around since 1977, uh, offering settlement services for newcomers to Canada from all different immigration categories. Before we start, we would like to introduce you to the land acknowledgement. The land acknowledgement is a tradition here in Alberta to acknowledge the First Nations and their lands. Let's start.
Territory. We acknowledge the Treaty 7 nations, the Piikani First Nation, the Siksika First Nation, the Kainai First Nation, the Stoney Nakoda First Nations, and the Tsuut'ina First Nation. We acknowledge the ancestral territory of the Siksikaitsitapi, the Blackfoot Confederacy, and the home of Métis Region number 3.
Thanks for Calgary Foundation for producing that wonderful video for the land acknowledgement. Today, our presenter is Owen from National Bank of Canada, and he will be presenting about the differences between different saving plans and the mistakes that you need to avoid when you apply for a saving plan with different banks in Canada. Owen, please go ahead and introduce yourself.
Hey everyone, can you hear me?
Yes.
Okay, perfect. My name's Owen Camperdo. I work for National Bank of Canada. My role with them is, my job title is Personal Banker Wealth Management. That basically means I do long-term investing and saving strategies for clients, primarily to help them save for retirement, but any other kind of savings goal as well. I also assist my clients with estate planning, identifying insurance needs, finances, taxes, legal issues, things like that. For tonight's purposes, though, we're going to be focusing on mostly TFSAs, a little bit of information on RSPs, and how these two types of accounts contrast each other a little bit, and some of the advantages and disadvantages. So primarily tonight's presentation will be about TFSA accounts with a little bit about RSPs. So first time I've done this presentation, and I think the first time it's been done this way in general. So if you got any recommendations at the end, I'm always open to that sort of thing. I expect to be talking for about 25 minutes, and then I'll have at least half an hour at the end for questions if there are any. Yeah, okay, so I guess let's dive into it. Go ahead and share my screen. Can everybody see the first slide?
Yes.
Perfect, thank you. So start off with some of the basics. What is a TFSA? TFSA stands for tax-free savings account. It's not to be confused with an RSP. Many times people they hear the term tax-free and assume it's referring to income tax-free. That is not the case. That's a separate thing, and we'll get into that in detail tonight. basically, TFSAs are designed to help people save and invest. That's the purpose of them. They're designed to be simple accounts, flexible accounts, and accessible accounts for everyone. TFSAs are available to basically all Canadians as long as you're of age of majority. You have to be 18 years old and have a valid social insurance number. Those are essentially the only two requirements to qualify. There is no need to have any earned income. Now, this is a little bit in contrast to RSPs, but we'll circle back to that later. You pay no additional taxes on any money inside of a TFSA, either now or in the future. That's their primary advantage and the primary purpose of that sort of account. They're very flexible, like I said, and there's very few situations where a TFSA is not going to be to your advantage. They're very useful in almost all saving strategies. So that's one of the reasons we're going over them tonight. TFSAs are always registered with the CRA, that's the Canada Revenue Agency. That's the organization in Canada that's responsible for paying your taxes to. So anytime you open up a TFSA, it will be registered with the CRA, the Canada Revenue Agency. I guess I'll apologize. There are a lot of acronyms in banking: TFSA, RSP, CRA. I'll try to keep them to a minimum, but unfortunately they're a little bit unavoidable. TFSAs can be opened up at essentially any bank or credit union in Canada. I'm unaware of any that don't allow it. The government created them to, like I said, help people save as a most flexible way they could. And they can be used to hold a wide range of investing and savings products. So you can hold almost any sort of investment inside of a TFSA with a few limitations. Just a couple of facts about TFSAs. Do be aware some of these stats are from 2016, so they're a couple of years out of date now, but still mostly relevant. About 12 million Canadians have a TFSA. That's about half of all Canadian adults. 7.3 million of them make regular TFSA contributions. 1.9 million have maxed out their TFSA contribution room, so you can see that most people don't take advantage of the maximum. In total, a few years ago, there was $46 billion held inside of TFSAs, with the average annual contribution being $6,300, just a little bit less than that. So now we're going to dive into how a TFSA works. I'll try to keep it as simple as possible. There's quite a few rules associated with it. They seem a little bit more complicated than they are once we actually dive into what they look like. This first slide here is to show and illustrate what your maximum contribution limit is for a TFSA. The TFSA program was started in 2009, and when it was first started, you had a contribution limit of $5,000. So as long as you were a Canadian citizen over the age of 18 and had a social insurance number, you could have got a TFSA and put $5,000 into it. In 2010, 2011, and 2012, they increased the contribution limit by $5,000 every year. So what that meant is by the end of 2012, anyone that was over the age of 18 from 2009 could have put up to $20,000 into a TFSA. In 2013, they adjusted the limit for inflation. So they kept increasing the limit, but by a larger amount to compensate for inflation, to $5,500. They did that for the next couple of years. In 2015, the Conservative government took over and they increased the limit to $10,000. The following year, the Liberal government decided that took over after that had decided that was too much of an increase and lowered it back down to $5,500. And that went on for 2016, 2017, and 2018. In 2019, so last year, they adjusted the limit for inflation again to $6,000. And that adjustment for inflation will continue in perpetuity, essentially, unless the government changes the legislation. What this means in total is You could have up to $69,500 as long as you were a Canadian citizen with a social insurance number of age of majority in Canada. That's your maximum limit as of 2020, and it will go up again next year. It's important to note that any withdrawals you make from a TFSA, you lose that contribution room for 1 year, but you'll get it back the following January. And any unused contribution room is yours to be used in the future in perpetuity. It never goes away. You always get your contribution room as far back. So if you lived in Canada since 2008 and you've never contributed to a TFSA, you get your full contribution room if you went into your bank or credit union tomorrow. It never goes away. I'll give you an example that actually happened to me about how the contribution limits can be affected by contributing and withdrawing from the account. I actually had a customer who had a TFSA with $69,500 in it. He had maxed out his TFSA. One day he came in and he said, "Owen, I want to buy a Cadillac, so I'm taking all my money out." I said, "Okay, have fun." So I cut him a check for $69,500. He left, went to the car dealership, and he got cold feet. He decided he didn't want to spend all of his savings on a car. So he came back and said, "I changed my mind. I want to put my money back into my TFSA." Well, I told him that's good, but you won't be able to do it until next January because he'd used up his contribution room for that year. Comes back in January 2021, all the money can go back into his account, plus the new increase limit for 2021. So I hope that makes sense. If there's any questions about it, I'm happy to field those at the end. Like I just mentioned, there's no limit to the number of years your unused contribution room can be carried forward. They're yours permanently. So it never goes away. You always get to take advantage of whatever room you were eligible for. Do be aware there are penalties for excess contributions. Anything over that, assuming you qualify for the maximum amount, anything over that $69,500 is subject to a 1% penalty every month. So as an example, let's say you had an extra $1,000 in your account. You put in $1,000 above your limit. You're going to be charged $10 a month or $120 a year, which equals about 12% a year in penalty. This penalty will continue forever until one of two things happens. You either withdraw your over contributed amount, or the penalty is so much that you've gone back down to your limit, or you wait so long that it rolls over to the next calendar year and the limit increases again and you're no longer over the limit. RSPs are a little bit different than that. RSPs, you do have a slight wiggle room to go over your limit. That is not the case with TFSAs. There is no grace room at all. If you go over, you will be penalized. The CRA, like I said, tracks your contribution limits. So that's how they know if you've gone over your contribution. You can actually log on to the Canada Revenue Agency website. You can make your own profile with them and you can log on and it will tell you exactly how much you are allowed to contribute to your TFSA and how much you have contributed in the past. It's very important to stress that your contribution limit is your responsibility to keep track of. No one keeps track of them for you. Only you can track your contribution limit. So that's why the CRA offers the online platform where you can check how much you've contributed. The reason that no one tracks them for you is because there are no limits to how many TFSAs you have. You can have multiple TFSAs at multiple banks and they don't communicate with each other. So if you have one TFSA at one bank with $69,500 in it, and you go to another bank and try and open up another TFSA and put in $2,000 in it, neither bank knows that you've over contributed by $2,000 in that example. The only people that will know are you and the CRA. If you only have one TFSA with one institution, of course, that one bank knows how much you've contributed to your one account, but they won't keep track of your overall limit. So now we're going to dive into what are some of the major advantages to having a TFSA. Amounts that are withdrawn from your TFSA have no impact on your tax situation. So if you're getting government benefits, such as child tax benefit, GST credits, old age security, guaranteed income supplements, any contributions or withdrawals from your TFSA will have no impact on those whatsoever. So you're never going to have any kind of clawback by taking money out of a TFSA for any of your government benefits. Any holdings in the account are tax-free holdings. So anything you put in there does not have any impact on your income or anything like that. Any money that's gone into a TFSA is after income tax funds. So the tax-free portion of it is really from any growth from the money in the account, not any kind of tax deferral for income purposes. Whenever you're dealing with the TFSA for yourself, there's always, I like to highlight 5 key questions to ask yourself. First question, did you already contribute to your TFSA this year? And what about any previous years? Like I said, any contribution room available to you is always available to you. You never lose it. So it's important to keep track of it and make sure you're taking the full advantage of the contribution room you're allowed. Did you withdraw from your TFSA this year? And what about any previous years? Using my previous example with the gentleman buying a car, any withdrawals, that room is still considered used up for that calendar year and will be replaced in January of the following year. Do you have a single TFSA or multiple TFSAs at multiple institutions? Like I said a few minutes ago, your TFSA limit is yours to track because you can have many TFSAs at many banks. The example I like to use, the CRA doesn't care if you have one TFSA with $69,500 in it or 69,500 TFSAs with $1 in each, as long as you don't exceed that global limit. The second 2 questions to ask yourself are somewhat related. Did you maximize the returns of your non-registered investments? And did you maximize the tax efficiency of your non-registered investments? It's important to note, like I said earlier, you can buy a wide range of investment products inside of a TFSA, anything from just cash savings to investments that have a gain and loss component to them. The reason I mention that is because not all investments are taxed the same. Interest income, for example, is taxed just like regular income. It's from the CRA's perspective, it's the same as your paycheck. But an investment, any kind of investment that has a potential to lose money, you are subject to what's called capital gains tax. This is a kind of tax that's a little bit more affordable, for lack of a better term. Instead of paying your full income tax bracket, you would pay half of what that is. The reason I mention that is because you have to consider that whenever you're investing inside of a TFSA. Does the investment I'm buying make the most sense for my personal situation based on my tax bracket and the returns I'm hoping to make from that sort of investment? Any kind of investment held inside of a TFSA, whether it's the interest-bearing investment like I described, or an investment that maybe can lose money, anything inside of a TFSA is taxed at 0%. That's the main advantage of a TFSA. I also like to mention that although your limit is $69,500, that does not include any growth from your investments. That's just the money you've contributed. So if you put in $69,500 and you choose an investment and now your money has grown to $70,000, you have not exceeded your limit. So any growth that goes over your limit is okay. It's just money that is contributed by you that goes into the account that you can't exceed. It's going to be all tax-free growth regardless of how much money you make. So whether you make $10 in your TFSA or $10,000 in your TFSA, all of that's going to be taxed at 0%. And that's why they're so popular. Here I'm going to illustrate a very popular and effective saving strategy that's very easy to implement and take advantage of the TFSA in combination with an RSP. Using your tax refund from an RSP contribution for a TFSA contribution. If you invest your tax refund, and for the purposes of my example, I'm going to say your tax refund is $1,842 each year. What would that look like if you did that year over year over year for 25 years? So we're going to take a look at the next graph here. Now there's a lot of data points on here. I don't want to get too complicated with it. Just the general concepts are what I'm trying to get across here. So in this example, someone that saves $5,000 into their RSP and they pay a 36.8% tax rate will get a tax refund for that contribution of $1,842. Now, most people generally spend that money. They get their tax refund for their RSP contribution and they go out and buy something. That's fine. You can do that if you like. But if you are able to save it, I'm going to show you the kind of compounding returns you can get over time. So again, this example assumes we're saving over 25 years and that you're making 3.75% per year in returns. So you put your $5,000 into an RSP, you get your tax refund in the mail for $1,842. So your $5,000 contribution into your RSP only cost you $3,158. Rather than spending that $1,842, you put it inside of a TFSA that is also invested in the same investment, making 3.75% over 25 years. After 25 years, your RSP is going to hold $221,000 and your TFSA is going to hold $81,000. So that's a lot of money you can save very quickly. You'll notice the category that says deferred tax. If you were to withdraw that full $221,000, you'd then pay income tax on it of about $81,000. So you can see all the savings you made in your TFSA almost perfectly offsets any income tax you'd have to pay on that RSP money. I'm going to get a little bit more into detail on that in the next slide here. So why save that $1,842 in a TFSA every year rather than just a regular bank account without that tax-free element? Well, that's illustrated right here. If you're putting away that $1,842 a year and making your 3.75% interest over 25 years, if you bought that in a non-registered account, you'd have to pay income tax on any of your investment profits. Well, over 25 years, that equals just about $30,000 in taxes on your profits. But if you bought that same investment inside of a TFSA and it grows to $81,000, you've paid no tax on any of that profit. So you can see you've saved $30,000 just by taking your tax refund, putting it into a TFSA rather than spending it, or investing it in a non-registered account. It makes a big difference over a long period of time. Is a TFSA right for you? I get asked a lot, should I buy a TFSA or an RSP or both? And really the answer is going to kind of depend on yourself. I'm going to describe RSPs a little bit on the next slide, but first I'm going to talk about a couple of the disadvantages of TFSAs. There are a couple of downsides to them. They're not major, but still important to note. Whenever you invest inside of a TFSA, if you buy a kind of investment that can potentially lose money, so it's got some risk with it, any losses inside of a TFSA are not deductible. So what that means is, if you bought that same investment in a non-registered account, so an account that is not an RSP and not a TFSA, if you lose money, and then a couple years later you invest again and make money, you can tell the CRA, well, I lost money in 2020 and I made money in 2021. So these two things offset, so I shouldn't have to pay taxes on it. So if you lose $1,000 in 2020 and you make $1,000 in 2021 in a non-registered account, from the government's perspective, you don't have to pay any tax because the loss and the gain offset. You don't get to take advantage of that in a TFSA. In a TFSA, if you lose $1,000 investing, that's unfortunate. There's no upside to that at all. Any interest, if you take out a loan to invest in a TFSA, which is a complicated strategy and should not be done without consulting a professional, the interest in that sort of loan is not tax deductible, so that's another disadvantage for TFSAs. The most important thing to keep track of with TFSAs, like I've said a couple times already, it's your job to track your contribution limits. If you start using your TFSA like a checking account, it's going to be very difficult for you to track your contribution limit. It's going to be very quickly, you're going to go over and you're going to get charged a penalty. So it's very complicated. They should not be designed, or pardon me, used like a checking account. They are intended for saving purposes. Now we're going to get into a little bit about RSPs versus TFSAs. But to do that, we obviously need to have some basic information of RSPs. So I'm going to give you a couple of kind of pointers about how RSPs work. Anytime you contribute to an RSP, you deduct that money from that year's income taxes. So a basic example would be if you make $50,000 a year and you put $5,000 into an RSP, when you go to file your income taxes, you're essentially paying income taxes on $45,000 because that $5,000 is tax protected. You will pay tax on that $5,000 in the future. So a lot of people ask me, well, what's the point? If I put the $5,000 in the RSP now, sure, I don't pay taxes on it now, but I have to pay tax on it down in the future. Why did I bother doing that? The thing you have to ask yourself is what is your tax rate now versus what you expect it to be in the future? If you're making a large amount of income now and your tax rate, your marginal tax rate is 48%, you want to shelter as much money as you can from that high tax rate. In the future, when you're maybe retired and your income is much lower, so you're only paying a 30% tax rate, you want to take that money out then and pay only 30% tax on it. So you put it in at 48%, you took it out at 30%. You still paid some tax, but you saved that 18% difference. And that's how RSPs are designed. So whenever you're talking about, should I save in an RSP or a TFSA, the number one thing to ask yourself is my income higher now, or is my income going to be higher in the future? And that's going to be a major factor, which I'll get into a little bit more detail in a second. The other thing to keep in mind with RSPs is the contribution limit is affected by your income. It's not like a TFSA where you get that free increase to your contribution limit every year, regardless of any requirements other than being a Canadian. You have a RSP contribution limits are based on your income, your last year's income. So you can only contribute to an RSP up to 18% of last year's income, or up to a number called YMPE, which is $27,000. So 18% of your income or $27,000, whichever is lower, that's your RSP maximum. So with that in mind, we'll do a little bit of contrasting. Well, what is better to invest in, a TFSA or an RSP? Number one thing to answer to this question is everyone's situation is different, and everyone should consult with their financial advisor before they make a decision as to whether to invest in a TFSA, an RSP, or a combination of both. Everyone's going to have a unique situation, so I'm not going to tell anyone here one is better than the other. There's always going to be a situation where the right choice is different for everyone else. As a general rule of thumb, like I said, if your income is going to go up in the future, you're better served to invest in a TFSA now. If your income is going to go down in the future, you're better served to put your money in an RSP now. So if your income is high and it's going to go down in the future, RSP is generally better. If your income is low and going to go up in the future, TFSA is generally better now. Another way of looking at it is using that same example of your, let's say, well, that's okay. I'll actually get into that on the next slide, so I don't get too far ahead of myself here. different kinds of people that may want to contribute to a TFSA over an RSP. Personal business owners, people that own their own store or their own business, quite often pay themselves in the form of dividends. Dividends do not qualify as income from the CRA's perspective for growing your RSP room. So you don't get any RSP contribution room. So your only option is to save inside of a TFSA. People that are full-time investors, so people that make a large portion or maybe even all of their income from investing, maybe in the stock market, for example, those kind of returns do not count as income that grows your RSP room. So just like business owners don't qualify for RSP contribution room, their only option is to invest in a TFSA. So these two examples here, excuse me, their only option to save is a TFSA. Another kind of person that might want to take advantage of a TFSA over an RSP, someone who has a good company pension. If you have a pension from your employer, that pension that you're getting from your portion and the company's portion that saves for your future counts against your RSP room. You don't get to keep all your RSP room if your company is saving a pension for you. This is called a pension deduction. And in some situations, you can have such a good pension that it might eat up all of your RSP room. You don't have any RSP room left over because you're getting so much money from your pension. So in those situations, people, their only option is to save in a TFSA. Another one that the TFSA is a much better choice is a stay-at-home parent. If you're a stay-at-home parent, your income right now is zero. So contributing to an RSP doesn't have any advantages to you because you get no tax deduction. If your income is zero, you can't save any money on taxes, so you don't get any tax deduction. So there's no advantage to saving in an RSP. In that situation, you'd only want to save in a TFSA. Another kind of person that might want to save in a TFSA is a retiree. Once you hit the age of 71 in Canada, you're no longer even eligible to contribute to an RSP. You are now required to start withdrawing from an RSP. It's part of the RSP program. Once you hit 71, you can't put money in anymore. You can only take money out. You have to take out about 7% a year until the account is depleted. So what I see quite often, retirees that don't need that 7%, they have to take it out. They don't have an option in it, but they don't really need the money. So rather than spending it, they turn around and invest it in a TFSA, similar to that previous example I gave where you kind of compound your returns over time. Another very popular TFSA saving strategy, people that have just paid off debts. If you have a line of credit or a car loan and you just finished paying it off, you already know you can afford to pay that amount of money monthly. You were paying it for years on your car loan rather than spending it. Very popular to start saving that inside of a TFSA to get those long-term benefits. Running a little bit behind here, so I'm going to speed up a little bit. Young people, same example as before. If you're not making any money now and you expect to make more money in the future, TFSA is generally going to be a better option. Young people generally are working part-time at most. They're going to school. Their income is very low. So there's no advantage to taking your tax deduction now because you can get a better tax deduction later in an RSP. So it's generally better for them to save inside of a TFSA. In the event of a family separation and a divorce, TFSAs can be used to help settle the divorce amount. So if you take your TFSA, although it is generally not included in a divorce settlement, it can be used to help offset the divorce settlement. So if one spouse needs to pay off another spouse to make everything broke in half, a TFSA is often a very popular tool to accomplish that. The last slide here on TFSAs, in the event of your death, you can name a beneficiary for your TFSA. So it can go to your children or your cousin, whoever you want to name. You can name anyone you like to inherit your money. The most popular thing to do with TFSAs is name your spouse as your beneficiary. If you name your spouse, they not only get to inherit the assets inside of your TFSA in your death, they get to inherit your contribution room as well. So rather than having just $69,500, your spouse could have $139,000. That option is only available to your spouse. Sorry, guys, I rushed through those last slides a little bit quick just because we're running out of time and I wanted to leave lots of time for questions. Here's my my phone number, my email, my contact information. So if anyone doesn't want to ask a question here in this public forum, please don't hesitate to reach out to me through either email or phone, and I'd be happy to answer any kind of questions privately. Ahmed, that was it for my presentation on TFSAs. I'm happy to field any kind of questions that came up from that.
Thank you so much, Owen. This is a lot of information.
I know it's a lot.
Yeah, it is a lot, and I think we need time to digest all of that. So what I suggest right now is just to open the floor for people who are attending with us here on Zoom to ask their questions. If you have a question, please start your mic, unmute your mic, and start asking the question if you have. Do we have any questions here from Zoom? Yes, go ahead, sir. Shaminder?
So this limit, what we are talking about, 69,500, is this for a family or for an individual?
Great question. It is individual. So anyone that's over the age of 18 qualifies for their own limit. It's important to keep in mind that when I kept saying 69,500, that is only for people that have been in Canada since 2009 or before. If, for example, you have a child and you just immigrated to Canada this year and they just got their social insurance number this year, but they're 19 years old, for example, their limit will be $6,000 because you only get the room where you were eligible to get that room, which again requires you to be of 18 years or older and have a Canadian social insurance number. So everyone's limit is going to be different, like I said, but everyone has their own individual limit, not a family limit. So you're going to have your own limit. Your spouse is going to have their own limit. Your children are going to have their own limit, whether they are or are not 18 yet, whenever they reach that age.
Thank you.
No problem.
Thank you so much for asking. This is a very good question.
Great question.
So,
Yeah, that's one of the more complicated parts of the TFSA that gets very confusing. So that's why I was a little bit trying to be sensitive about it. It's a lot of data points to take in.
okay, any more questions from people with us on Zoom? So again, our friends here, feel free to take the information here on the screen. You see the Owen's number. If you have a question that you want to ask on private, feel free to take the contact information of Owen here, and you can call him and even arrange with him for an appointment to discuss in details your situation. As Owen mentioned, we have a lot of details and everyone's situation is unique. So it's better to discuss that privately if you wish. But again, we still have some time if you have any general questions, not specific to someone's situation, you can still ask questions now if you wish.
We'll give people a few seconds to think of any questions. The main takeaways from all the data that we went through today are that your contribution limit is your own and yours to track. That's the number one thing, and that you can invest in really whatever investment makes sense for you, and that it's always best to make a informed decision that's best for you and your family as to whether you want to invest in an RRSP or a TFSA. So those are the three bulletin points I want to take away. Everyone's situation is unique is kind of the overall takeaway.
Can you give some idea on the type of investments available in TFSA? So
I'm
under
sorry,
the
what?
umbrella of TFSA, what are the different type of investments available?
Oh, good question. It's basically anything. There are some weird limitations. For example, you can't buy certain foreign entities. For the most part, you'll be able to buy essentially anything there with a couple of very rare limitations. For example, I don't think you can hold rare earth elements, for example, inside of a TFSA. I might be mistaken about that. But basically, any kind of investment you're buying at your local bank or credit union will be eligible to be held inside of a TFSA. It's important to keep in mind with that as well. So let's say you went to the bank and you bought a GIC. The GIC is going to have its own restrictions inside of your TFSA. And then the TFSA is going to have its own rules that we went through today involving contribution limits and so on. So it's important to remember that your investment is going to have some rules and your TFSA is going to have some rules, and they might not necessarily be one and the same. But for all intents and purposes, if your question is what kind of investment can I buy, anything at your local bank should be eligible with maybe some very extreme exceptions to that. So stock, bonds, GICs, mutual funds, cash savings, all of that stuff that you're getting at your local bank will be eligible.
Is there any percentage limitation for each kind of investment, or it is flexible?
Great question. No, it doesn't matter what you do. That's a conversation to have with your financial advisor, whether you want to invest all in GICs or all in mutual funds, for example. It's whatever makes sense for your goals, your risk tolerance, but there's no requirement to have, for example, half GICs and half mutual funds. It's whatever makes sense for you.
Does this affect me?
Sorry?
Yes.
Okay, so I have a question. Is depositing cash the only way to contribute to a TFSA?
No, that's a really good question. No, you can contribute what's called in kind. So if you hold stock in a non-registered account, for example, you can transfer the shares into your TFSA, but be very cautious when you do that, because although you can transfer the shares in using that example, that will trigger taxes on everything before it goes in. So let's say you bought a stock for $10, and the stock has now grown to $12, and you want to actually transfer the actual stock into your TFSA, not the cash. You can do it, but as soon as you transfer that in, you're going to have to claim that $2 profit as taxable income this year. Anything that grows in the future will be tax-free, but you can't put anything that's already grown into your TFSA. That's a really, really good question.
Thank you.
Another example would be I hope that made sense. Did that make sense,
Yeah.
Shirley?
Yes, it
Okay.
did.
Perfect. But great question. That was a really good one.
Do we have any more questions in here? So, Owen, please, can you just give us a little bit about the risk factors regarding the different types of investment or saving?
Oh, I can. I don't necessarily want to get into that too much on, because that in of itself can be a full presentation. I generally break things down into a couple of different classes to try and keep this as simple as possible. Cash savings, GICs, mutual funds, stocks and bonds. Those are kind of the four baskets as I see them.
Mhm.
Cash savings is the least risky. Stocks and bonds are the most risky. And whenever a guy like me says risk, we're talking about the possibility that you can lose money in it. Cash savings, you can't really lose money in it. As long as it's insured by the federal government, you're going to make a small amount of interest. There's almost no scenario outside of the government, Canada ceasing to exist as a country, where your cash savings is going to lose value. That is not the case with stocks. You can buy stock in a company and the company can go bankrupt. Like I said, I don't want to get too much into that because everyone's situation is different, and in and of itself, that's probably a 2-hour conversation by itself. But TFSAs can hold any one of those things. What is right for you? You have to talk to your financial professional.
Thank you so much. I just want to, if we don't have any more questions, I would like to introduce Huda. She is here with us today, and I thank her so much for giving us the chance to have that collaboration between Immigrant Services Calgary and the National Bank of Canada. If you please, Huda, come to the camera, turn on your camera and introduce yourself. Okay, Huda Ahmadi is a regional director of residential and financing manager. She had a bachelor degree of economics from the Concordia University. She has been working in the banking industry for 19 years. Huda, can you please introduce yourself and speak a little bit about National Bank of Canada?
Of course. Can you hear me?
Of course, yeah. Go ahead.
Perfect. Good evening, ladies and gentlemen. I wanted to thank you so much for attending this event. I know it's like the day after your work or after a hectic day. So I just wanted to thank everyone for attending this educational session. And as well as I really hope that this educational session will motivate you all to plan and meet your trusted financial advisor, and plan your short-term and long-term goal, dreams, and objectives. I just want you to remember one thing. Banking in Canada may be a little bit different, or it could be actually very different. But once you learn it, it could be very, very simple. So don't be shy to reach out to your banker, talk to them, ask them as many questions as you can, read, Google search and educate yourself, and you'll see it's very, very simple. And you will, once you understand it, you're just gonna give yourself so many options, because the options and the diversity in product and solution that exist in Canada are enormous. I also wanted to take this opportunity to thank the devoted team of Immigrant Services Canada for organizing these beautiful events, educating and helping our community, making sure that our financial, mental, and physical health are in control. And on behalf of the team of National Bank, I wanted to wish you all a great night. I hope you really enjoyed it, and stay safe.
Thank you so much, Huda, and thank you so much, Owen. I see that the people with us here are thanking you so much for the information, both of you, and also on Facebook, I see people thanking you so much for the detailed information. And we hope that our viewers and the people watching us on Facebook has got the answers for them some of their questions. And Owen, if you have a final thought before we end our Facebook Live.
Yeah, the last thing I'll mention is just to clarify, I am not a licensed stock professional. So again, if you are interested in a specific kind of investment, you need to talk to your advisor. So that I'm not making any kind of recommendations from that perspective. The last thing I'll mention is if you do have any questions, don't hesitate, like I said, to reach out. I'm more than happy to talk.
Okay, thank you so much, Owen. Thank you for everyone who attended our presentation today. Have a good night, everyone, and goodbye.
Have a fantastic
Goodbye.
night. Bye.
Good night.